deep dive time, well, shallow dive, we really just want to go over what capital gains taxes are. So one of the things that we always hear about in the United States is how rich people don't get taxed the right percentage or the fair percentage. They don't pay their fair share. And we kind of want to talk about why they don't pay their fair share. We always hear like, why does Elon Musk pay less in taxes than the average school teacher? Well, capital gains taxes is one of the reasons why.
Yeah.
And we kind of want to go through the history of the capital gains tax, what it means, the current rates, and kind of discuss like why it even exists in the first place.
Mm-hmm.
So the capital gains tax was first made back in 1907. And originally, the short-term rate for capital gains tax and the long-term rate were taxed the same. What does that mean? So short-term means any trades made in like a 2-year time span, that's short-term.
Right now it's 1 year.
Right now it's 1 year.
So
okay.
so a capital gain is a profit made from the sale of an asset. So basically this means if you buy an asset today and you sell it in 364 days or any time before that, that's a short-term capital gain, that profit that you make. If you buy it today and you hold it for longer than that and then sell it, it's a long-term capital gain.
Thank you. That was a great explanation. So with the short-term capital gains and the long-term capital gains being taxed at the same rate back in the day, that was making it some very bad behavior because they put the capital gains rate lower than labor income. Why would you do that? Well, they wanted to encourage investment. They wanted to encourage more people putting money into the market. And to do that, they thought, we'll make the capital gains rate lower than the labor rate. Well, what that encouraged people to do was speculate a lot and do a lot of speculation. So these short-term capital gains was getting taxed at very, very low rates and encouraging all the speculation. It was actually very, very bad for market volatility.
Yes.
And regulators and policymakers needed to change this. So they split it in the 20s for a long-term capital gains rate and a short-term capital gains rate. So as Ben was saying, your capital gains rate for the 1-year trades were the same as your labor income. Yep. Your capital gains for a long-term trade was no longer your labor income. And the number has fluctuated throughout the years. Sometimes the percentage has been all the way up at 40 back in the 1970s. Sometimes it's been all the way down to where it is now at 15 or something, right? So it's been going up and down. The highest amount of effective tax that was paid was actually started under Ronald Reagan, which I didn't expect. In 1986, the Democrats controlled the House. I'm pretty sure they controlled the Senate. And they passed a bipartisan bill with Ronald Reagan at the time that increased the capital gains rate for long-term and short-term capital gains taxes. Okay. And that kept all the way up until the Clinton administration. And then halfway through the Clinton administration, the Republicans took the House, and then they passed a bipartisan bill to cut it. So Clinton worked with the Republicans to cut the capital gains rate. Okay. Now, capital gains taxes were actually something that were pretty prominent during the 2016 presidential election. Donald Trump actually would attack Hillary Clinton for not taxing capital gains at the same rate as labor income back during the debates. And he would attack things like the carried interest loophole. Yeah. And
which is a good thing to attack.
Yeah, it's a great thing to attack because the truth is Hillary Clinton helped write a lot of these tax documents that we're complaining about right now. So very effective rhetoric, but when Trump gets into office, he does not make good on any of his rhetoric. No. And currently our capital gains tax rates are as low as they've ever been. So where are they at now?
Right now, short term, still at the level of labor income. Long term, 0% on capital gains if you make less than $45,000 a year, 15% for $45,000 all the way up to $554,000, and then 20% on everything over $554,000. Yeah. Which is much lower than you would pay on labor.
Much lower than you pay on labor. If it was paid on labor, we'd be talking about 37%.
At the top income bracket.
Yeah, but the top income bracket for this long-term capital gains is only 20%.
Yeah.
So here's the problem with this. Is it good policy?
Good or bad is
good or bad policy is the question. Now, for short term, I think we both agree, should be taxed the same as labor, maybe more.
Yeah, probably more.
Right. I think we really want to discourage speculation.
Yes, speculation doesn't help.
We want people to invest their money in a reasonable way, thinking about long-term growth.
Yeah, because speculation, what it tends to do is it helps gamer traders,
Right.
right? Who are not intending to actually invest in companies developing in a way that they think will help the economy, right? It's just, how can I follow or predict human sentiment well enough to make a quick buck?
Yes, that's exactly right.
And if it's not that, if it's someone gambling otherwise, then it's dangerous to the investor, right? Then you kind of want to discourage them from thinking they can make big profits if they're less informed about it, because they can lose a lot of money.
Yeah.
So short term, I would say higher than labor income. Long term, it is good to have long term investment in companies. I was thinking about this, and I might be okay with long term rates being below labor income, because what I'm thinking about is like the income that you make from your labor, those dollars are going to go to say goods or services that are mostly just going to contribute directly to the profit margin of a company. They aren't going to be as instrumental in building out like infrastructure or new technology development that that companies look to raise money from equity from.
Right.
Whereas long-term investment might actually be dollars that are more useful for those higher value added activities that happen in the economy. Do you think that makes any sense?
I think that makes sense. I think I definitely want to encourage long-term investment, right? My thing that we've talked about before offline is, does this effectively do that? Does this encourage long-term investment, or would they long-term invest anyway?
True.
Right? Would these guys, because if we think about it, like you said, this is passive income. And if this is passive income, who cares if you're getting 20% taxed or 35% taxed? If it's passive income, you're not doing anything for it anyway.
Yeah, you're still going to want the passive income.
Yeah, I mean, and it's not like you have another alternative.
I guess that's the question.
There's nowhere to really go.
Are we missing other alternatives that they might choose? I don't know.
I mean, like, then I mean...
bonds or...
No, but even then...
Because it will never match the rates that you're getting.
No, it'll never match the rate that you're getting here. So there's really no way for other place for them to go, unless they go to like an international market. Unless they decide... Sure. But, they're still going to get taxed in the U.S. if they're U.S. citizens.
Okay.
So it doesn't matter. Yeah.
So there's probably at least room to move these rates up.
Yeah.
Even if they can't go to 100%.
No, of course.
Right? But they can... But 20 is probably lower than you need to have it to make sure you're not discouraging.
I like the idea of having 0% for lower incomes generated.
Because you want lower income people to get in the wealth building business.
Yes, exactly. I want people to be encouraged to start long-term investing.
Okay.
So I like that process.
Okay.
But Joe Biden is recently pushing for an increase in the capital gains tax rate by making another bracket over $1 million and then putting that tax at 37% for over $1 million.
Okay.
Which is the best compromise.
Yes.
Right? If you're not going to make the 500,000 to 1 million be 37%, at least make $1 million up be 37.
Yeah. Yeah, I agree with that, definitely.
But
I also understand not making it too much, even for like a 500,000 number, because you're talking about a long-term capital gain, right? So like you're talking about a person who's made a long-term investment. I almost start to take the side of like rewarding them for staying in the market long, making $1 million off of staying in the market long enough to get that. Yeah.
That's why it's important to invest in a Roth IRA. If you are a youngin right now, if you invest in a Roth IRA, you won't pay capital gains taxes when you retire.
Yep.
All your money is pre-tax and you take it all out and it's not even considered income. Just the way to go.
Totally.
Yeah, that's the history of the capital gains tax. Pretty cool stuff.
Awesome.
Maybe we'll do a little more of these little deep dives about different tax regulations.
Sure.
All right. Thanks, guys.
Bye.